$1 back in 1925 is worth $17.41 today. That's a 94% loss of purchasing power. What can history teach us about protecting wealth from inflation? Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. This is the first of a series of videos on inflation, historical, current, and future, and how you can protect your wealth from current threats of future inflation. The average inflation from 1925 to 2025 was just 2.9% annually. It was not 2.9% every year, though. In the 1940s, wartime inflation averaged about 5.5%. In the 1970s, we had stagflation. Inflation averaged 7.1%. It peaked at 13.5% in 1980. I remember this clearly. And it was unfortunate because we were having a recession at the same time as we were having inflation. And then in 1921 through 23, we had a spike that hit a peak of 9.1% in June of 2022. So the compound effect of these spikes in inflation have resulted in $1,000 in 1925 being $17,410 in 2025. So I'd like to go back a little bit and talk about what happened with stagflation in the 1970s because it's so relevant to where we are today. It was a bit of a perfect storm. We had the Vietnam War spending plus the Great Society program. In 1971, Nixon surprised the world by taking us off the gold standard. We were already off the gold standard in that you couldn't convert your money to gold. There were all sorts of laws that prohibited. What he did was he admitted the reality that already existed. Then in 1973 and 1979, we had the OPEC oil embargoes. There was a 400% price increase in the price of oil. Money supply growth during this period hit 13% annually. Nixon's fatal error was in August 1971, he invoked a wage and price freeze. Wage and price freeze never work. Prices are just signals to the economy. Hey, this is where the demand is. This is where the resources are needed. This is where the profit is to be made so that you will produce more supply to meet that demand. When you interfere with the price signals, as most Soviet countries have done in the past, everything falls apart. And sure enough, just like in Russia, we got shortages and pent-up inflation. And when we finally lifted the wage and price freeze, inflation exploded from 4 to 12%. From 1973 to 1974, as a result, the stock market lost 45% in real terms. So the experience of the United States actually was relatively tame relative to other countries. Back in the 1970s, I was living in England. In the fall of 1979, when I came to the United States, youth unemployment was 25%, and inflation peaked at 25%. But the biggest story was German hyperinflation. In 1914, 4 marks were equal $1. In 1920, 65 marks were equal to $1. And by November 1923, 4.2 trillion marks were equal to $1. And as a result, and we've seen the same thing in Venezuela, Caracas especially, in other countries where they're just printing money with wild abandon. In these countries, workers get paid twice a day. Prices change in real time. You can sit down for dinner at a restaurant. By the time you pay, the price has gone up. And the middle class was wiped out entirely. And the lesson we got from Germany and from the United States and from the United Kingdom and every other period of inflation is that debt monetization leads to a loss of confidence, which leads to economic catastrophe. So our most recent experience with inflation has been post-COVID. In March 2020, inflation was at 0.3%. We had low inflation going into the pandemic, and the slowdown in economic activity brought it close to zero. But by June 2022, we were at a 40-year high at 9.1%. May 2025, we finally got it under control at 2.4%. What caused the spike? There was a $5 trillion fiscal stimulus. I think most economists would agree that at the beginning of the COVID shutdown, the need for fiscal stimulus was real. The problem with fiscal stimulus, be it on the left or the right, is it's very hard to slow the spending once you've started, or to raise the taxes once you've dropped them. We also had supply chain disruptions, which is a cost-push inflation. We had labor shortages, and we had energy price spikes. The Fed responded appropriately, if a little slow. They raised the rates from 0 to 5.5% in the 18-month window. During the period of 2020 to 2022, the money supply grew by 40%. So it's no surprise that we had this level of inflation. I think the key takeaway of this video should be inflation is a wealth destroyer. It's a silent destroyer, and its devastating impact affects the conservative investor more than anyone else. Our historical lesson is that fiat currencies eventually devalue. We can do a whole nother video on why fiat arguably is better than the gold standard. But be that as it may, it's what we've got. Today, what's interesting though, is inflation is different in different parts of the United States. And in the next video, we're going to talk about that. We're going to talk about why is inflation different in different parts of the United States, and how does that make Fed policy difficult? How does that affect Texas differently from, say, Minnesota, New York, California? If you find this historical perspective of value, consider subscribing to this video series if not already. And if you'd like to discuss how these patterns might affect your specific portfolio, our team is always available for a confidential consultation. We wish you the best of investment success. Thank you.